Have you ever wondered how accounting organizes financial information? Every business generates financial activity on a daily basis. Customers make purchases, businesses pay bills, assets are acquired, loans are borrowed. As transactions increase, so does the amount of financial information that must be tracked. To keep everything organized, accountants use a system called the Chart of Accounts. The Chart of Accounts helps businesses categorize financial information so it can be recorded, summarized, and reported properly. In this video, we'll learn what the Chart of Accounts is, why it's important, and how it helps accountants stay organized. What is Chart of Accounts anyway? A Chart of Accounts is a complete list of accounts used by a business to record financial transactions. Each account has both a name and a number. The account name describes what the account represents, while the account number is simply a code used to organize accounts within the system. This is a simplified example of a chart of accounts. In practice, businesses typically include many more accounts depending on their size and operations. Note that the account numbers are not universal. Different companies may use different numbering depending on how they structure their accounting system. What matters is that the numbering is consistent within that company. Now let's look at why businesses actually need it. The Chart of Accounts plays an important role in accounting. It keeps financial information organized by ensuring that every transaction is recorded in the appropriate account. It also improves accuracy because transactions are classified consistently. It makes financial reporting easier. Since information is already grouped into accounts, preparing financial statements becomes much more efficient. Finally, it supports better decision-making. Managers and business owners can quickly access the information they need to evaluate performance and make informed decisions. Without a chart of accounts, financial data would be difficult to track, analyze, and report. Now that we know why the Chart of Accounts is important, let's see how accounts are grouped within the system. All accounts in a Chart of Accounts belong to one of the 5 main categories. Assets are resources owned by the business. Examples include cash, accounts receivable, and equipment. Liabilities are obligations owed to others. Examples include accounts payable, salaries payable, and loans payable. Equity represents the owner's interest in the business. Examples include owner's capital and owner's drawings. Revenue represents income earned from a normal business operations. A service business may use an account called service revenue, while a retail or merchandising business may use sales revenue. Expenses represent costs incurred by the business. Examples include salaries expense, utilities expense, and rent expense. Every account you encounter will belong to one of these 5 categories. Understanding these categories is important because they form the foundation of the accounting system and financial statements. Now that we understand the categories, let's see how account numbers are commonly organized. Many companies group accounts using number ranges. For example, asset accounts often start with 1, liability accounts with 2, and so on. This makes it easier to identify account types quickly and keep the chart of accounts structured. Just to repeat it again, it is important to remember that numbering systems are not universal. One company might use 101 for cash, while another might use 1000 or 1100. The important thing is not the exact numbers, but consistency within the business. Now, let's try to check your understanding. I will show different accounts. Your task is to identify which category each account belongs to. Interest expense. Interest expense belongs to the expense category because it represents a cost incurred by the business, specifically interest paid on borrowed money. Notes payable. Notes payable belongs to the liability category because it represents an amount the business owes, usually based on a written promise to pay. Owner's capital. Owner's capital belongs to the equity category because it represents the owner's investment and ownership interest in the business. Service revenue. Service revenue belongs to the revenue category because it represents income earned from providing services to customers. Building. Building belongs to the asset category because it is a resource owned by the business that provides future economic benefits. Now, let's summarize the key points from today's lesson. A chart of accounts is a structured list of accounts used by a business to record and organize financial information. Each account has a name and often an account number to help keep the system organized. We also learned that all accounts belong to one of 5 categories: asset, liability, equity, revenue, or expense. Lastly, we also learned that account numbering systems can vary from one company to another. And that brings us to the end of our lesson on the chart of accounts. Before you go, I'd like to hear from you. Which account category do you find the hardest to understand? Asset, liability, equity, revenue, or expense? Leave a comment below and I'll reply to help clarify it.